Hi guys, welcome to 365 Days, 365 Concepts. The concept that we're going to understand today is private equity markets versus public markets. So what do you mean by private equity market? When a company that is not listed, we are talking about the shares of those company and the markets related to that. Right. So let's say, for example, you take, your board on, all the, Shark Tank startups, your Shadi.com, your Lenscard, all of these are what? Private companies which are not listed yet. So the market of those shares is called as private equity market. So then what is public market? Sir, public market is the market of listed companies. The shares that are listed. So your Tata Motors and stuff like that, which you can trade on BSE and NSE, right? So private equity markets, sir, are of course of a smaller size when you compare it with public markets. Public markets, of course, is on a larger scale. A lot of companies are listed. Market caps are huge. There's a huge amount of, basically the size which is huge, and your private equity markets is pretty small, right? In private equity markets, naturally, sir, the liquidity is very less. Sir, what do you mean by that? So let's say, for example, I'm talking about a listed company, something like Reliance Industries or Tata Motors. I want to go and buy the stock of them. What do I do? Am I going to go and approach Mr. Ambani, or I'm going to approach Tata and all of those things? No. I have an exchange, I have NSE, I have BSE. I can simply place an order and buy the share. That means there's a platform where lakhs of investors come in and they sell and buy the shares, which are listed shares. But sir, for private company, is there a platform like that? Sir, can I buy the shares of Zepto? Can I buy the shares of Big Basket? Can I do all of that? No, sir, I cannot buy the shares because there's no platform like NSE or BSE. I might have to go to the company and ask them that, are you looking to raise some money? Are you looking for investment? Then I can invest and they can issue me shares. But there's no platform like that where I can do that, or I can buy it from an existing investor. But the options are pretty few. And whenever there is no centralized platform, and not a lot of what do you call not a lot of people are exchanging the shares, then the liquidity becomes very less. So that is what the point is when it comes to the second point, which is lesser liquidity, right? Share price is usually negotiated between the company and the investor and not by the market. So whenever I have to buy a listed company shares, whatever is the market price, I'll have to deal in that. But when it comes to a private company, Big Basket, Zepto, and stuff like that, I might have to negotiate the price with the company. They will tell me a certain price, a certain valuation. They will tell me, let's say, a $1 billion valuation, and I might say that no, I don't think that it's a bit too much. I might have to be a little less, or they'll tell me 100 million. I might negotiate and stuff like that. That'll keep on happening, right? So the point is that the share price are negotiated between the investors and the company, and not by the market. Market doesn't give a price like they give for listed companies. There is nothing like that here. Your price is negotiated, right? Lesser disclosure, hence there are going to be lower reporting cost. Now, if I'm a listed company, I am, let's say, for example, Reliance Industries. So I have to, there are so many disclosures that I have to do. You go and see BSC's website and search for stock Reliance. You'll find so many disclosures that have to be done. You have to submit annual report. In annual report, there has to be audit report. You have to submit shareholding pattern. You have to submit whatever annual general meetings you have done, the reports relating to that, all of those things, any corporate disclosures that are there, any corporate actions that have happened, all of these things, so much to disclose. And as a company, it is not your expertise as Reliance here. You'll have to hire a CA firm. You'll have to hire somebody else to do all of that work for you. So the reporting cost in itself, sir, they increase a lot. But for private companies, sir, they are not listed. There is no platform. They don't have to, go for these guidelines where they are, what do you call? They have to disclose annual report. They have to do all of that. They have to publish their financials. They have to, shareholding pattern and all of that has to be disclosed. None of that, sir. So the point is that the disclosing, the reporting cost is very less. And then there's a lesser corporate governance due to lower reporting requirements and public scrutiny. Now, of course, sir, my stock is not listed. So I'm not going to go through public scrutiny like a public company does. Because their stock is listed, they are going to be talked about on CNBC, Z News, all of these things are going to be happening. They're going to be under public scrutiny and a public eye. But I'm a private company, of course, not that big. Big companies are, of course, under scrutiny, but I'm a private company which has a decent business. I'm not going to be under public scrutiny. People are not going to talk about my share. All of these things are not going to happen, right? And there's lesser corporate governance as well, sir. What is corporate governance? And it is a set of internal rules and regulations. Now, whenever I have to do a lot of reporting, let's say, for example, I'm Reliance and I have to report a lot to BSC, I have to have a lot of internal set of rules and regulations so that I can generate those reports. But when I don't have to make all of these disclosures, then there is no need to. I can just have lesser corporate governance and all of those things. And because my reporting requirements are not that lot, they're not a lot. That is what it is. Now, in private company, you can focus more on the long-term prospects due to lesser public pressure. Now, whenever you're not under pressure, you can always think long-term and you can take risk in the shorter term. You are not afraid of having lesser earnings in the shorter term and all of those things like a public company does. A public company will always be under a fear. Because if their quarterly earnings are not that great, their share price will start falling. And they will be constantly under a public pressure that, oh, we have to perform. Otherwise, what will people think about us as a company? And, then our stock price might take a hit and stuff like that. But a private company doesn't care about anything. Private company is like, okay, this is good in long term. I can take risks in the shorter term, and it's fine, even if my earnings are going to be less. That is what it is. And potentially greater return for investors as firm goes public. And whenever you see a lot of private companies, when they go public through an IPO, you would notice a lot of times that the return is quite a lot. Like, you would have seen that in case of Swiggy, where the private investors got an exit, and stuff like that. So that happens quite a bit. Sir, what are the examples, sir? First example of private companies, venture capital. Venture capital are what, sir? Venture capital are companies that are in their early stages of development, right? In their early stages of development, which are just starting out, right? So usually these investments are very illiquid, as we have already studied for private companies, right? And the investors generally who want to be there in the longer term, they generally hope to, sell the shares that they have acquired in such private companies through an IPO or through, any other form. So that is, or they can sell it in an IPO, or they can sell their shares to any other firm. So let's say I've invested in a venture capital company. I can sell the shares to another investor who is looking to invest in this company. That can also happen. So that is there. So the next point is LBOs or MBOs, which is leveraged buyout or management buyout. Sir, what is leverage buyout? Leverage buyout is buying a company which is under distress. What is management buyout? Management buyout is whenever a management buys out a company, its own company, which they are, the management of, which is suffering and which is under distress. So, that is there. What are the targets generally here, sir? They are generally, companies which have enough cash flows to service the debt. So because, you're borrowing and investing in a company, so, obviously you would want companies to have enough cash flows, even if they don't have profit, so that you can extract those cash flows and pay, for the interest that is there on your debt, right? That is what is there. And the next last point is, private investment in public equity. So whenever a public company is looking to raise money again, but at a faster pace, so obviously going through IPO again, not IPO, raising that through public is a long process. You have to, take hundreds of approvals, and then there is a chartered accountant that comes in. All of those reports have to be there. You have to submit prospective statements. All of those things happen. It's a long process. It takes time to raise money, and it's also very costly. But I need small amount of money, and I need it in a huge manner, and I need it fast. So what do I do, sir? I invite, or I, send invitation letters to certain private investors who have deep pockets. I tell them that, listen, please give me 1 crore rupees. Let's say I have to raise 100 crores. I will send it to 100 investors, and I'll ask them, please give me 1 crore rupees each, right? So, sir, but ultimately, sir, it is a public company, means a listed company, and a listed company is sending letters to these HNIs. So HNIs are going to invest in this company. Sir, I get it. Okay. But sir, ultimately they're going to get shares of public company only, na, sir. Then why private investment in public equity? It's substance over form. Because in substance, the private company, the what do you call, the HNIs who have deep pockets are becoming investors with the public company. Okay, sir, but the manner in which it is happening, where they are invited, and the entire transaction is flowing as if a private investment is happening, that is what makes it PIPE, or private investment in public equity. And these are a type of private, what do you call, investments, right? Types of private investments. So that was your private equity markets versus public markets. I hope you guys have understood everything. Yeah, if there are any doubts, feel free to ask in the comment section. And please like, share, comment, and subscribe. I'll see you guys another day with another concept. Bye bye.